Let us start the lecture number 5. In today's lecture, actually, we are going to discuss two things. One is the concept of qualifying loan in trust. Another, we'll be discussing, inshallah, property income. Okay. So let's see what do you mean is qualifying in trust. Number one. Qualifying in trust is deducted from total income. From where do we deduct this qualifying in trust? Actually, we deduct qualifying in trust from total income. Qualifying in trust is not deducted from any individual income. Qualifying in trust is deducted from total income. That is the concept number one. Second, what do you mean by qualifying in trust? Actually, qualifying interest means which is the loan which is taken for qualifying purposes. Interest paid on that loan is a qualifying interest. Now the next question arises, it comes in the student's mind. That question is, what are the qualifying purposes? Let us discuss what are the qualifying purposes. And you need to remember these qualifying purposes also. If loan is taken for any of the following purposes, then the interest paid on such a loan can be deducted from total income. Then interest paid on such loan can be deducted from total income. Number one, investment in partnership. Someone takes loan to invest in partnership, then that is a qualifying purpose, and interest paid on this sort of loan is a qualifying interest. Second, purchase of plant and machinery for employment. Someone takes loan and then buys plant and equipment and uses that plant and equipment in employment. That is also a qualifying purpose. Let me give you an example of this. The example could be, let's say Mr. X has taken the loan, and from that loan, what he did, he bought a laptop, and nowadays he's using this laptop in his employment. So in that case, whatever interest that Mr. X is paying, that will be a qualifying interest, and it will be deducted from total income. Third one is investment in employee controlled company. Let's talk about a company where employees, they control the company, means employees, they have the ownership of the company more than 50%. If you want to make investment in that company, and for making investment in an employee controlled company, you take the loan. Let's say you took the loan and then you invested in a company which is employee controlled company, then it is a qualifying purpose, and the interest paid on such a loan is a qualifying interest. And qualifying interest is deducted from total income. Fourth, to take loan, to give loan to a partnership where individual is a partner. If someone has taken the loan to give loan to a partnership and that individual is a partner in that partnership, it is also a qualifying purpose. The last one, to invest in shares of closed trading company. Closed company means where less than equal to 5 shareholders, they are having control. Let's say you are just a shareholder. You took the loan, number one, and then you invested. Then you bought the shares of a closed trading company. Closed company means where control is with less than equal to 5 shareholders. Control means less than equal to 5 shareholders are having more than 50% holding in that company. Such a company is called closed company. So if someone takes loan, step one, then that person buys shares of closed company, then interest paid on that loan is a qualifying interest, and qualifying interest we deduct from total income. So you need to remember these 5 examples of qualifying purposes. And loan taken for any one of the purposes is a qualifying loan, and interest paid on qualifying loan is a qualifying interest which is deducted from total income. That's it. Now let us start property income. Now It's time to start property income. Let me tell you first few basic things, then we'll study from the book. Property income. Number one basic concept is for individuals. Let me clear one more thing. Actually, property income is rental income. We are not studying buying and selling the properties. We are actually studying that someone has a property and you have given that property on rent. Then how do we calculate property income? So actually, another name for property income is rental income. Another name for property income is rental income. So for individuals, property income is taxable on cash basis, that is receipt basis. What do you mean by this? So for individual, cash basis, receipt basis is the default category of property income. What do you mean by cash basis? Let me explain. For example, you have given a property on rent, okay, step 1. Step 2, your tenant is living in that property, and let's say he's living in the property since, you can say, start of the tax year, and in entire 12 months he lived in your property, but he has given you only the rent of 8 months. Even though he has spent 12 months, but he has just given you so far rent of 8 months. The rent of 4 months is your receivable, but for rental income we will be considering only 8 months rent, the rent which you have actually received. The rent which is accrued, 4 months rent is receivable. We never work on accrual basis for individuals. So you're not going to take rent receivable. You are going to tax only that rent which you have actually received. So for individual, property income is taxable income, is taxable on cash basis, receipt basis. Second, accrual basis will be applicable where individuals' property income is more than 1,50,000. If someone is having property income, rental income more than 1,50,000, then for that individual, property income is taxable on accrual basis. Which means then we have to work on, we will consider rent receivable as well. But normally 150 is a really big amount, it does not exceed for individuals. So then it's very simple. If someone is having property income less than equal to 150, then simply that property income is taxable on cash basis. For companies, property income is taxable on accrual basis. For limited companies, property income is taxable on accrual basis. But you need to know that right now we are studying individuals, we are not studying companies. So these are the few things basic which you need to know. So when it comes to property income, actually this is rental income. For individual, property income is taxable on cash basis, receipt basis, which means that we are not going to consider rent receivable. Accrual basis still applicable, only it is applicable for those individuals that have property income more than 1,50,000. For companies, still accrual basis is applicable. Now, what are the more concepts? Just a minute. Property income, cash basis. Okay, the cash basis is now the default basis for calculating property income for individuals and partnership. However, it is still possible to use accrual basis. An accrual basis must be used if property income exceeds 150. For limited companies, it is still accrual basis. In many cases, there will be no difference between cash and accrual basis. The following are treated the same under both cash and accrual basis. Security deposit. Actually, there is no tax on security deposit. Why? Because security deposit is not your rental income. Second, replacement furniture relief. Actually, replacement furniture relief is only available in the event of replacing the furniture. When you are buying the furniture first time, then you will not get any relief. Replacement furniture relief is only available on replacing the furniture item. Furniture is a really big, I would say, category. There are many things which fall under the umbrella of furniture. Like it could be your television, bed, it could be even crockery, it could be washing machine. Simply all you need is just remember one thing. A replacement furniture relief is available on replacing the furniture. When you are initially buying the furniture, then replacement furniture relief is not available. Relief for property income losses is same premium. Restriction of finance cost. What do you mean by restriction of finance cost? We'll study that as well. So there is no difference in tax implication in these 5 areas. Either we are on cash basis or accrual basis. But all you need is, you just remember one thing. What is that? For individual, cash basis is a default category. Let us discuss one more concept, that is use of mileage allowance. For example, Mr. X is the owner of a property and Mr. X wants to give his property on rent. So to find out the tenant, Mr. X drove his own car. Let's say Mr. X, this I'm assuming, Mr. X drove his car 12,000 miles just to find out a tenant. Now the question arises that Mr. X has used his personal car, assuming 12,000 miles to find out the tenant. So what about the expenditure which he has incurred on that car for finding out the tenant? All those expenditure are deductible or not? Now listen, and listen carefully. If someone that is simply landlord of the property, owner of the property, is driving his car for the sake of that property, then you will get allowable expense according to mileage allowance. What do you mean by mileage allowance? So according to HMRC, for first 10,000 miles, your allowable expense is 45 pence per mile. Over and above 10,000 miles plus more, it is 25 pence per mile. And these basically miles limit and all this It is also given in your exam formula sheet as well. So for first 10,000 miles, it is 45 pence per mile. If you go above 10,000 miles, then it is 25 pence per mile. Okay. So how do we use this? For example, your examiner says that Mr. X has drove. Mr. X has drove 12,000 miles his own car for the sake of giving property on rent. So let's say we need to find out what is the allowable expense. So allowable expense will be 10,000 miles into 0.45 plus 2,000 miles into 0.25. Then whatever comes, we need to write this. It will be 4,500 and 500. It's going to be 5,000. So 5,000 is an allowable expense. While calculating property income, we will be deducting these 5,000. So someone, basically the owner of the property, if uses his or her own car for for business property income, then according to the authorized mileage limit, you will get allowable expense. Okay. Individuals and partners can now use HMRC approved mileage allowance when calculating property income. This is an alternative using actual motor car expense. You are not supposed to deduct actual motor car expense. You are supposed to deduct what comes according to authorized mileage allowance. And authorized mileage allowance for first 10,000 miles you get 45 pence per mile, and over and above 10,000 miles you will get 25 pence per mile. In property income, actually we have three topics: property income, rental income calculation. So that is head lease, normal lease, sublease. What do you mean by this? We'll see this. Room relief, rent a room relief. All concepts will come. Let us first see this. Property income deals with rental income assessed on cash basis for individual, and for limited companies accrual basis. Property income, first we have to take rental income, allowable expenses, repair and maintenance, advertisement, agent fees, insurance charges, water rates. So normally there will be no bad debt issue. Why? There will be no bad debt issue. Actually, we are not going to consider any rent receivable as a rental income. As we have just discussed, for individual, property income is taxable on cash basis. So actually, there won't be, while calculating, there will be no issue of bad debts. Reason, we are actually working on cash basis. Counseling tax. Again, water tax, counseling tax, you are supposed to deduct when they are actually paid. Redecoration expense. Replacement furniture relief, we'll discuss in detail what do you mean by replacement furniture relief. So you will get taxable property income. So property income finance cost. Actually, what do you mean by property income finance cost? It is possible that, let's say, Mr. X took the loan, number one, and then from that loan he has bought the property. And he has given that property on rent. Number one, what Mr. X has done, number one, Mr. X took the loan. Number two, he bought the property and then he has given that property on rent. So what will be the treatment of finance cost? We will see that. What sort of, how do we deal with this sort of finance cost? There's a, you can say, special treatment of dealing with the finance cost. Number one, you're not going to deduct that finance cost while calculating property income. Look at this. In this my format, you cannot see any finance cost. So if someone takes the loan and then buys the property and gives that property on rent, then how do we deal with that finance cost? Second, it is not necessary that someone after taking the loan must buy the property. That is also possible if you are the owner. What you did? So number one, you took the loan. Just if you are an owner of the property, what you did, you took the loan, number one, and you used that loan. Let's say you have used that loan. You have used that loan for repairing this property which is on rent. Still you are not going to deduct interest payment from this format. So now the question comes in our mind, then what are we going to do with that interest payment? Isn't it normally interest payment results in tax savings? Yes. We'll study that. How do we deal with finance cost? Now let us see a question. This question will let you know the answer of different questions. Calculate Frank's income tax liability. On 6 April 2020, Frank purchased a freehold house. The property was then let out throughout the tax year at a monthly rent of 1,000. Frank partly financed the purchase of the property with a repayment mortgage, paying mortgage interest 4,000 during the tax year. So Frank partly financed the purchase of the property with a repayment mortgage, paying mortgage interest 4,000. Actually, they have took the loan and then they bought the property, and interest payment on that loan is 4,000. Okay. The other expenditure on the property tax year 2021 is 1,300, and this is allowable. There is another 1,300 expense which is allowable. For the tax year 2021, Frank has a salary of 80,000, and we need to calculate Frank income tax liability. So let us calculate Frank's income tax liability on Excel. So you need to have my book. Without my book, obviously, earlier classes will not create any problem, but later on classes will create a really big problem if you don't have my book. So make sure you must have my book. Question 11. So the property was let throughout the tax year. Nothing is mentioned. We are assuming that rent is received. So rent received is 12,000. Now it says Frank partly financed the purchase of the property with a repayment mortgage. Interest payment is 4,000. We'll see this, what to do with this 4,000. The rent received is 12. Frank partly financed the purchase of the property with a repayment mortgage. And the other expenditure on property for the tax year is 13 allowable. Less for the allowable expenses. So allowable expenses. Look at the question. Allowable expenses are 1,300. So we have rental 4,000. Allowable expenses 1,300. Okay. So we'll get the property income. Just a minute. So your property income is 10,700. Okay. So Fang is having a salary of 80,000. So salary is 80. So we'll get the total income. So total income is 90,700 and all income, entire income is a non-saving income. Let us deduct personal allowance. Personal allowance is 12,500. From total income, when you deduct personal allowance, so you will get the taxable income. So taxable income is 78,200. Okay. Now let's calculate income tax. So far, the interest payment, which is 4,000, which Mr. Fang has given, 4,000 interest payment, we have not dealt with that. So you need to wait to see that how do we deal with this interest payment. But you need to wait for that. Income tax. Basic rate band is 37,500. Let's take here 20% of this. Now let us take this. We need to deduct basic rate band. This amount actually falls in high rate band. Tax rate is 40%. Okay. Now what? Please let us see the question again. How much? Look at the payment of 4,000 interest payment. This is interest payment of 4,000. While solving the question so far, we did not work on this 4,000. Now it's time to work on that 4,000 as well. Number one is while calculating property income, you are not supposed to deduct interest income. Obviously, now the question comes in our student mind is that certain question 11 itself says they have made interest payment of 4,000. So what to do with that? Now listen and listen carefully. When you have taken the loan to buy the property or you have taken the loan to repair the property, in both the cases, how do we deal with that interest payment? Keep looking at the Excel. We need to less finance cost relief. So how do we calculate finance cost relief? Actually, you will get finance cost relief and it is going to save your tax. Your interest payment is 4,000, you can see in the question. You just need to multiply this with 20%. So finance cost I believe is 800. So income tax liability. Just add them all. So your income tax liability for Fang is 22,980. So rent received is there, allowable expenses 1300, property income is there, salary, total income, personal allowance, taxable income, basic rate rent is 37,500. 20% of this 37,500 actually gives us 7,500, and 40,700 falls in a higher rate rent. So that is income tax liability. A very important point is how do we deal with finance cost? You just need to take that interest payment, multiply that interest payment with 20%, whatever comes, it will be deducted from income tax calculation. As you can see in this question, this 800 comes in with negative, but this 800 is a finance cost relief. What is this 800 doing? Basically, this finance cost relief is reducing your income tax liability. What is this finance cost relief is doing? Actually, finance cost relief is reducing your income tax liability. So the simple treatment of finance cost is whatever the amount of the finance cost is, just multiply that finance cost amount with 20%. No matter individual is a high or basic or additional rate taxpayer, if that individual has taken the loan, all you need is, obviously you are going to pay the interest. So on that interest you will get the finance cost relief. That interest payment will multiply with the tax rate. Which tax rate? 20% will give you finance cost relief. And finance cost relief is always available according to the basic rate 20%. No matter individual is a higher additional rate taxpayer, you will always get finance cost relief according to the basic rate band limit of percentage of 20%. And what finance cost relief does, it actually reduces your income tax liability. Okay. Now look at this. Let us discuss a little bit more replacement furniture relief. Number one. So this replacement furniture relief is only available when you are replacing your furniture. Initial cost of furniture is not deductible. Actually, when you are going to replace the furniture and you need to replace the furniture with similar items, then you will get replacement furniture relief. So what are the examples of furniture? Beds, television, fridges, freezer, carpets, curtains, floor covering, washing machine, cooker, cutlery, crockery. There is no relief for initial cost. You will not get any relief on initial cost. Replacement furniture relief is only available on replacing the furniture. There is only one relief when assets are replaced. Also, relief is not given for any cost which represent an improvement. So you will actually get a replacement furniture relief when you are replacing your existing old asset with similar asset. Then you will get the replacement furniture relief. But if you are actually replacing your existing furniture item with a new furniture item and which has, let's say, better features than your existing asset, in that case you need to check in the question. Your examiner is going to actually mention, for example, your examiner is going to tell you, if you replace your machine with a similar machine, washing machine for example, then cost will be £400. But you bought the washing machine which has a washer dryer as well, and in earlier machine you did not have any washer dryer. So actually the dryer is a capital expenditure. Here that dryer is a capital expenditure. So you have to read the question again. Replacement furniture relief is available on the event of replacing the furniture relief with similar asset. The amount of the relief is reduced by any proceed from selling the old asset. For example, your old asset is having scrap value of £100, and you bought a new machine similar to your existing. New machine is costing you 500. So actually now your replacement furniture relief is 400. Why? Let me explain you. Replacement furniture relief, why it is 400? Actually you bought the new machine for 500, but your previous machine is having a scrap value of £100. So your replacement furniture relief will not be 500, your replacement furniture relief will be 400. So while calculating property income, you need to deduct replacement furniture relief of 400, not 5. Because your old asset is having the scrap value, residual value of 100. Now let us discuss a new concept of lease premium. What is this concept of lease premium? Number one, if someone in UK gives his residential property on rent, in addition to rent, that individual receives premium as well. You're not just getting rent, you have also taken the premium. In that case, entire premium is not taxable. On premium, you will get relief as well, and relief is going to reduce your taxable premium amount. So, if you are giving your residential property on rent and you are getting a lease premium as well, then entire lease premium is not taxable. From that lease premium, you need to deduct the relief. So how do we calculate the relief? Let me tell you the formula. Number one, let's write the premium as whatever the premium is, then just deduct relief. Relief is n minus 1 into 2% into premium amount. You will get taxable premium. First you need to write the premium, then you need to deduct relief, n minus 1, 2%, multiply this with premium amount. What is n? N is actually lease term, and we are discussing a short lease. Short lease term is less than equal to 50 years. So you only get relief when you give your property on short lease. And short lease term means less than equal to 50 years is a short lease. So how do we calculate taxable premium? Number one, you have to take the premium and then just deduct the relief. How do we calculate relief? N minus 1 into 2%. Then we need to multiply this with premium amount. So from that premium, you just need to deduct the relief. So you will get a taxable premium. For example, Mr. X has received, Mr. X has given his property on rent for 10 years, and he has received premium of 50,000. required. Calculate taxable premium. Okay. So Mr. X has given his property on rent for 10 years and he has received premium of £50,000. Number one, this premium is not refundable. Now the next question comes in our student mind. The question is, why would somebody is going to give us a premium? If, for example, tenant is giving a rent, that is itself a really big thing. Then why someone is going to pay us the premium? The answer to this is location of your property. Definitely your property location is, I would say, your property location is really good. That is why only you will get the premium as well. So what is the logic behind getting the premium? Why would someone is going to pay us the premium? There's only one reason. The reason is your property is actually at a very prime location. That's why someone is going to pay you the premium. So how to calculate taxable premium? All you need, just follow the formula. Formula is write the premium, then deduct the relief. You will get taxable premium. Just a minute. Let us see this on Excel as well. Lease term is 10 years and premium is 50,000. How do we calculate taxable premium? Just write premium first. That is 50,000. Now just deduct the relief. Bracket n minus 1, 10 minus 1. Then multiply this with 2%. Then multiply this with the premium amount. So relief is 9,000. So your taxable premium is 41,000. Taxable premium is so your taxable premium will be simply 41,000. So today we'll stop over here. In next class, I'll be discussing the concept of sublease, and we'll be discussing few questions on property income, where I'm going to explain you more about replacement furniture relief. And just a very important announcement, which I should have made earlier, but let me tell you right now. Very important announcement, and before making an announcement, I strongly believe that none of my student is having that practice which I'm going to mention right now. Actually, it is a very humble and serious request that please do not share your email address and password with any other student. Because by doing this, actually you are going to simply hurt financially to number of people, because teaching online, it is bread and butter for me and my family. And it is not only a bread and butter for me and my family, actually it is also a bread and butter for those people they are associated with me. Just passing this password and email address, your email address to any other student, that is going to be very honest, going to create a really big financial trouble for number of people. So it is a very humble and serious request. Never ever do that. Because your objective is, you have taken the admission, your objective is just study, clear the paper. If someone else is, if I strongly believe that you are happy with us, with my performance, you are happy, you are supposed to just recommend me with others. So it is a very humble request. Please do not share your email address and password of my portal with any other student. So thank you very much listening to me. Inshallah, in next class we are going to discuss more on this property income, and I'll be starting a new topic which is employment income, and employment income is an extremely important topic. So thank you very much for watching this video.